I'm Cynthia Rowland, and this is episode 45 of EO Radio Show. The IRS Form 990-PF is a complicated federal information return, which the Internal Revenue Code requires every private foundation to file each year. This week, I am delighted to have as my guest Tracy Hom, a certified public accountant with the firm Realize CPA. Tracy will address some frequently asked questions from private foundation directors and officers when they review their foundation's first Form 990-PF. We'll provide a brief orientation to the form and we'll cover some of these questions. Welcome to the EO Radio Show, your nonprofit legal resource. Brought to you by the Exempt Organizations Group at Farella, Braun & Martel. My name is Cynthia Rowland, and I'm a partner at Farella. I'm a business and tax lawyer with more than 30 years of experience advising clients on nonprofit and charity law. Through this podcast, our lawyers and guests will discuss a range of legal and business issues impacting the nonprofit world because we understand you work hard every day to make your community a better place to live and do business. Many of our programs focus on the basics, and at times we'll do a deep dive into narrow and complicated legal issues. Again, welcome to the EO Radio Show. We're glad you're here. My guest today is Tracy Hom. She's a partner in the San Francisco office of Realize CPA. Her tax practice is focused on providing tax consulting and compliance services to high net worth individuals and their related entities. These include trusts, partnerships, closely held businesses, and their private foundations. Tracy works to provide a comprehensive, thoughtful, and personalized approach to her clients' tax and financial situations. As an advisor to various family members, Tracy assists in planning, implementing, and maintaining complex estate planning strategies, as well as analyzing the tax and financial implications of various business deal scenarios. Tracy is a second-generation accountant following in the footsteps of her father, who worked in the governmental arena for over 30 years. She started in public accounting immediately after graduating in 2000 from the University of California, Los Angeles, and became a licensed CPA in 2003. In addition, Tracy has earned a Master's of Taxation from Golden Gate University. Thanks for joining me, Tracy.
I'm happy to be here. Thanks for having me.
I gather your father was a big influence in your professional career. So tell me a little bit more about how you came to be interested in this niche tax accounting practice, particularly with, focused on families.
Actually, in college, I was an English major. My father, who was a longtime accountant, asked, what I ultimately wanted to do with that kind of degree. You could teach, you could pursue higher education. And the thought was that I really didn't want to follow that pathway. And so he thought I should try accounting. And I did. And it was just one of those things that really clicked for me. And then after college, I went into public accounting at a mid-sized accounting firm down in the peninsula with similar clients, high net worth individuals. And just really got interested in kind of all the intricacies and complexities, and particularly how much of a relationship you develop with your clients as you get to know them over the years. And the focus really becomes on helping them, which I really appreciate. And frankly, the vast majority of my clients are really charitably inclined. Quite a few of them have private foundations. And so it's just been an area that's kind of developed naturally, I think, based on kind of our clientele.
Yeah, that's really cool. I do like, for me too, the personal aspect of really getting to know the clients and dealing with sometimes really complicated fact patterns. The facts are complicated and the law is really complicated, which is a great segue to the 990-PF, which is a really complicated form. I printed it out this morning just to refresh my memory on all the details. I think it's like a 13-page form that's really dense. Start us off. Describe the 990-PF and the different parts of it and kind of how they fit together as an overview. And then we can dive into some of these frequently asked questions.
Sure. The whole purpose of the 990, of course, is to report the foundation's financial matters for the year, balance sheet, income statement. But layered on top of that is kind of the IRS's concern that this is a type of entity that could, result in abuse. Clients, of course, who create a private foundation and donate cash or securities into a private foundation get an immediate charitable tax deduction. And so there's concern that the creators of the foundation might exercise, for example, too much control, that they might use the foundation for personal purposes or to do things that they shouldn't do, like engage in lobbying or other kind of prohibited transactions. And so The other part of the 990 is really a lot of disclosure so that the IRS can assess whether there's any sort of abuse going on. So there's a whole host of questions that I think we'll talk about a little bit later. And then there's disclosures in terms of, for example, how much you're paying people, whether they're your employees or contractors. And then, of course, how much you're giving away every year. There are requirements.
So that's a great overview. Starting from the top, the first page is an unusual sort of balance sheet. I see there's 4 columns on that page. Can you talk a little bit about the purpose for separating out the balance sheet? Actually, that's not the balance sheet. That's the revenue expenses. But anyway, there's 4 columns there. What's the point of that?
Yeah, I think this is the part that really differs from any other type of tax return, like an entity tax return, like a partnership or a corporation. The 4 columns are meant for some purpose, whether it's, disclosing, of course, the revenue and expenses of the foundation, or for kind of a latter purpose of determining, for example, if the foundation has given enough away to charity during the year and met its requirements. And then kind of the other purpose is also in figuring out the amount of taxes that a foundation owes. So a foundation does owe tax on its investment income. The first column is called revenue and expenses per book. And this is just essentially the revenue and expenses that a foundation will report on its kind of personal bookkeeping. So revenue would include things like gifts into the private foundation of stock or cash. It would include its investment income, so interest, dividends, capital gains. And then expenses, of course, would be anything that the private foundation pays for. It could include expenses for paying professional advisors like us. It could include investment manager fees if they have kind of managed assets within the foundation by an outside investment advisor. It could include taxes that they paid in the past. And of course, salaries that they might pay if they have employees on staff. The second column is the net investment income column. This is the column where you're essentially figuring out the income that will be taxable. And by tax, it's not a very high tax. It's a 1.39% tax. But pretty much all of the foundation's investment income, interest, dividends, and capital gains are taxable. I think one kind of special aspect of this calculation is that generally when you're calculating the capital gains on an asset that was donated into the foundation, you should, for this column at least, be using the donor's cost basis. Very often, for example, a foundation will record the fair market value of that stock, for example, that's received as its cost basis because that's, the value of what they received. But you actually have to look back to the donor and see what their cost basis is to figure it out. So very often this column results in a higher income figure because donors often donate lower basis stock, so higher gains, into their private foundation.
Just to put an example on that, when a donor contributes maybe very low basis founder stock after their company has gone public, so it's basically zero and it's worth $10 million or $100 million, even though 1.39% is a pretty low tax rate, that can be a huge tax hit. So that shows up in that column then. So that's going to be excess of revenue over expenses in the column B might be a whole lot more than column A.
That's correct. And then expenses in the net investment column are really only those, or should only be those that are directly related to investment income. So the most common one that I see is, for example, investment manager fees, because those are directly related to the generation of the investment income. And very often we will maybe prorate some of our fees if some of our time and billing relates to kind of managing some of the investments. The third column, adjusted net income, is not often used by most private foundations. It's more often used by something called a operating foundation, which I don't think we're going to get too far into today. But these are foundations that sort of act like public charities. They perform their own direct charitable functions. And so, for example, instead of giving money to another charitable organization like most private foundations do, an operating foundation might run its own programming for that specific charitable cause. And that kind of revenue and expense would go into this third column.
Right. And we do have another episode. We have some episodes focused on operating foundations. Listeners who want more details should go to the show notes. I've got links to the 990PF form itself and to our other episodes that talk about private foundations and operating foundations. So anyway, I digress a little bit. That's column C. And then the fourth column, what's in there?
The fourth column is disbursements for charitable purposes. And so this is where you're essentially summing up all the grants that a foundation has made during the year, and then any expenses that are directly related to kind of the charitable purpose of the foundation. And so once again, that might be an allocation of some expenses. It might be an allocation of some professional fees. The one thing I wanted to note about this column is it's very clear in the instructions for this form that this column must be on a cash basis, meaning, if you've accrued to give away some funds by the end of the year, but technically haven't given them away, it should not necessarily be reported in this column yet. I wanted to mention that the sum of the columns B, C, and D may not equal A. And that's generally because some of the foundation's expenses might be allocable to what we call administrative costs. And that is something that's totally okay. I know very often I run into foundation advisors who are very confused by that aspect. So I just wanted to clarify. It doesn't all have to balance or equal.
Right. That's a great point. Sorry, I skipped over that. Anything else on the first few pages about that really dive into the assets and liabilities, gains and losses? And then there's the tax calculation in part 5.
I don't think so. I think we talked about the excise tax a little bit already. We talked about how the gain or loss on the sale of assets could be calculated differently for the net investment income purposes.
And that does remind me, one other thing that I've seen catch new foundations by surprise. Private foundations are required to pay estimated taxes as well. So if they get in their first year a big contribution of marketable securities and sell them early in the year, they need to pay their estimated taxes and their penalties for underpayment, right?
That's right. The penalties essentially are an interest charge. And interest charges are relatively high with the IRS right now. They're in the 6 to 7% range. So it is best to kind of keep informed with your accountant throughout the year if transactions are happening and let them know. Estimated taxes are required if you expect the foundation to owe more than $500 of net investment.
That's a pretty low threshold.
It is.
All right. So then moving on to all those questions starting in part 6A, there's a whole laundry list of yes-no questions. Talk a little bit about those. What's the point of all that?
Yeah, so the point is to deal with kind of two main issues. Again, this relates to the IRS's concern that a private foundation could potentially be an abusive transaction because people technically still kind of control the money that's in the foundation. And so a lot of these questions are meant to address those concerns. The first concern is self-dealing, whereas, maybe somebody puts money in a foundation, gets that tax deduction, and then uses that money to benefit themselves. The general rule is that no part of a foundation's charitable funds should be used for the benefit of a donor or any officers of the foundations. These rules are extremely complex. For example, this could include engaging in transactions with the donor or the officer, such as having a loan or a sale between officers and creators of the foundation and the foundation. It's something that you want to be very careful with. One of the most common things that I see with my clients and I'm really careful with is, when they're making grants to a charity and, maybe they're getting some sort of table at an event or something in return. One of the things I'm careful with is kind of segregating those kinds of things out between the foundation and personal. And most charities are willing to work with us on it. So kind of bifurcating a donation so that we can, maybe have part of it be personal to the extent there is some sort of personal benefit, and then the charitable piece coming from the foundation. The second point of all those questions is that officers and donors of a private foundation are really charged with maintaining a fiduciary relationship with the foundation's assets, meaning that they can't take unnecessary risks with those assets. They must carefully invest those assets in a prudent manner and, for example, not invest all of the assets in one speculative high-risk investment. Really those assets are meant for charity, not necessarily to grow unnecessarily. So, you just want to be very careful with how you invest those assets. And there are quite a few rules about investments in a private foundation also. And then the last thing are just kind of prohibitions that all charities are subject to. For example, lobbying or engaging in kind of political anything political. The foundations are disallowed from participating in those types of activities. And so you will see questions on the 990PF about that as well. And failure to follow any of these rules and regulations could result in relatively punitive excise taxes by the foundation. So it is something to carefully review and make sure that you are kind of following all the rules for a private foundation.
So that's a great overview of pages 4, 5, and 6 of the 990PF include all those questions about these activities. The next thing we see on the form is a bunch of questions about the compensation of officers, employees, and contractors. Why are all those rules in there?
Yeah, so they're asking for kind of compensation you pay to your 5 highest employees and contractors. And the reason for this question is similar to kind of the previous host of questions we just talked about. It's to prevent kind of perceived abuses. And so by disclosing, for example, your 5 highest paid contractors or employees, they're making sure that the donors or the officers are not benefiting themselves, not being compensated, for example, unreasonably. Because once again, the donor receives a charitable tax deduction for putting this money into the foundation, and they don't want those monies to go into personally benefiting anyone unnecessarily. So that's not to say that you can't pay yourself a salary, but it needs to be reasonable in light of kind of the tax performed and kind of the industry as a general.
That's a really good point to mention. People don't have to work for private foundations for free. It's fine to be compensated, and the best defense or the best protection, while you don't specifically disclose your compensation survey in the 990PF, but the backup to this for the fiduciary board is having some sort of surveys that show that the compensation is reasonable. And the reasonableness is based on what the work they actually perform. It's not limited to comparables among nonprofits. A financial professional working in a private foundation can be paid the same salary as a similar company, business enterprise. So anyway, the IRS is not, there's no specific thresholds. It's just the disclosure that sometimes catches people by surprise. Let's talk a little bit about moving on. After the compensation to the directors, officers, and trustees, then there's some disclosures about the funds that are given away to charity each year. So talk a little bit about how much a private foundation needs to distribute for charitable purposes and how that shows up on the form.
Sure. Essentially, as a general rule, what we tell our private foundation clients is that a foundation must give away roughly 5% of their assets every year. The actual calculation is a little bit more complex, but essentially the actual computation on the form, the actual 990, takes into account the average monthly value of the foundation's assets. It reduces that by 1.5% that the IRS says you can maintain for use in charitable purposes. And then that's multiplied by 5%. And this amount less any kind of taxes due, excise taxes from the 1.39% net investment tax that we talked about earlier, is the amount that's required to be distributed. And you will see that on kind of buried towards the end of the 990. So what happens is going back to all the way back to page 1 of the 990, and that column D, the disbursements for charitable purposes, you'll compare that calculation to this one, this 5% calculation. And if you've given away more than that or equal to that, then great, you've satisfied the requirements for the year. If you're a little bit under, it's okay. You actually get a year's grace period to fix that under amount, and you can give it away in the next year without any penalty. But if you do not disperse those amounts for charitable purposes in that following year or by the end of the following year, then a pretty punitive excise tax of roughly 30% is imposed.
Yeah. So, and a couple of thoughts on that. The concept of set-asides can be used if a foundation doesn't think it'll be able to make the distribution of the distributable amount in a short period of time. And there's another episode, and again, we'll link that in the show notes, on how to get permission to have a set-aside for future payment. And the other thing that I think catches people by surprise, and you mentioned this, is that it's 5% of the average asset amount. I've had some clients somewhat in a panic when they make a big contribution near the end of the calendar year. And then they think, oh my gosh, I just put $10 million in. I've got to give 5% away by the end of this year. Well, first of all, it's way less than that because it was only held for a month or maybe even just a few days. And secondly, like you said, you've got the entire following year to make the distribution. So for a startup foundation, there's no need to panic about that 5% amount, but you do want to get right on it because for planning purposes, you like to know early in the year how much needs to be given away. And I'd imagine that's where the accountant can be really helpful also, is in helping to tell the foundation early in each year how much it needs to give away that particular year.
That's right. And that's something we do for every client. Make sure that they know, barring, of course, like you said, any changes during the year, but to make sure they're well informed so that they can make decisions as well. I do think it's an important part of at least our job in working with kind of the foundation staff.
Right. That schedule on page 9 of the 990 PF that shows the undistributed income, it's another 4-column page. That one took me years to really understand, but it usually just comes down to the last few lines. The analysis of line 9, I think, those are the numbers I usually focus on, is how much excess do I have? So am I really worried about how much I need to distribute this year?
Mm-hmm. Yeah. And that's an important thing to note too. If you end up giving away more than this 5%, the form will also track that for the last 5 years. And that can be used in a future year. Should you give away less than that 5%, you can use those previous excesses to kind of cover that 5% required distribution. So that's part of the complexity of all those columns on that page.
Yeah, it's crazy complicated. And then there's the operating foundations. There's another page that's a completely different approach to your minimum distribution requirement. I don't know if you want to say much about the operating foundation.
I don't want to say too much, but I will say that operating foundations are required to meet some additional tests, and that's what kind of those additional pages are for. Most kind of normal private foundations won't have to deal with those pages and can put NA on those pages.
I guess we could do a whole episode on reporting on operating foundation for purposes of the 990. So let's see. We've talked about the minimum distribution, the 5% carry forward. But let's talk about the list of charitable grants distributed each year. I guess this is the same for private foundations and public charities, but talk a little bit about how much has to be disclosed about the grantees.
So once again, the IRS, wants to know where the foundation's money is going. And so they require quite a bit of information here. So they require the name of the charity, the address, the type of recipient, the purpose of the grant, and the amount of the grant. So there's quite a bit of information that's disclosed. One kind of special aspect of private foundations is, unlike individuals, they could possibly grant to foreign charities or to individuals. So for example, I have a client right now that's starting a scholarship program. And so they can, with kind of some IRS approvals, make scholarship grants to individuals and still maintain their kind of charitable status. But all of that does require further reporting. And I would definitely recommend, speaking with your advisors about those kinds of grants before engaging in them, because there is quite a few things that need to be done before you can engage in that kind of giving.
Yeah, that's a great reminder that for scholarship and fellowship programs, private foundations need what's referred to as a pre-approved grant procedure, which you can get with your original exemption application for the private foundation, or you can request it later. So that's important. And then there's this whole episode, expenditure responsibility for grants to foreign organizations. And that's a whole lot of other complexity. Program-related investments is also a whole other topic and another degree of reporting that follows in the 990. Anything else worth mentioning? Have we triggered any other questions or difficult situations that you've come across that are worth noting for our listeners today?
Just a few things. The first is to make sure that you file the 990 PF on time. It's an extremely punitive penalty if you do not. Unlike a lot of other IRS tax returns that base kind of that penalty on the tax due, the IRS charges a per day penalty of roughly up to $105. So it can actually add up really quickly. The maximum penalty is between $11,000 and $56,000, just depending on kind of the size of the foundation. Again, make sure you file your 90 PF 4.5 months after year end, or you can also file for an extension to request an additional 6-month extension, but make sure you keep track of those deadlines to avoid those penalties. I've had a couple of foundations subject to those and extremely hard to get waived, even with a bunch of reasonable cause.
during the pandemic. And as the IRS shifted from paper returns to electronic returns, it seemed like a lot of charities, I don't know if it was just public charities or if private foundations ended up getting stuck as well, but there were a lot of late filing notices that went out, and it's taken a long time for that to work its way through the service. And yeah, like, you can get these late filing penalties waived in some circumstances, but sometimes it can be a huge effort of time and mental energy to get the IRS to get it out of this system. Anyway, I digress. Anything else? Any other last thoughts?
I think the other caveat I would have is to make sure you read and fill out every line of the 990PF. Even if it doesn't apply, I would recommend putting an NA or something like that to show that you've reviewed it and determined it's not applicable. Please make sure you review the instructions because there are certain schedules that need to be attached. For example, the 990PF instructions do request that you list every investment that the organization has. So unlike, just putting corporate stocks, they want to know what stocks
That's
you're
right.
holding.
A lot of those private foundation returns, the schedules go on for pages and pages and pages between the list of the grants made and the list of investments. That sometimes is a lot of pages.
It is. And then the same thing with any capital gain or loss transaction detail. That might be something else that might need to be attached as well. And so just recommend making sure that you look closely and attach whatever is necessary.
So as we wrap up here, are any tips on how the new foundation's board or officers can best set themselves up to make that first 990 as painless as possible? What do you tell your new clients? They're so happy they've got their new private foundation, they're up and running, and they haven't yet done a 990 PF. What do you tell them?
I usually tell them, well, first, to make sure that they're working with professionals, attorneys and accountants that are familiar with this form. I mean, I think this whole podcast has shown that the form is very complicated and you want to work with people that are very familiar with it. The second kind of caveat is that to maintain kind of open lines of communication throughout the year. So, the foundation staff, for example, keeping us updated on new donations received. And then, vice versa, us keeping them updated on the amounts that must be distributed, just so that they have that information for planning purposes. And then also, being updated on things like the investment income that the foundation received. If they sold something for a very large gain, we'll want to know so that we can calculate the proper estimated taxes and avoid penalties. For a lot of my private foundations, for example, they don't have accounting staff. And so very often what I'm doing is taking bank statements as part of the kind of overall process and creating that balance sheet and profit and loss statement for them. It's really helpful, I think, if that's done throughout the year instead of once a year when we have to do the tax returns.
Right. Yeah, that's a great point. Tracy, I can't thank you enough for joining me today. This is a really hard form to talk about. It's so much complexity to it. We'll put some useful information in the show notes. And Tracy, send me your thoughts on things we could add in there that'll make it easy for the first-time filer of the 990 PF. So thanks so much for joining me. I really appreciate it.
Thanks for having me. I really appreciate it.
We'll do this again on some other difficult form. So that's all for this episode. Check out the show notes for these resources we talked about. I'm Cynthia Rowland, and you've been listening to EO Radio Show, your nonprofit legal resource, brought to you by the Exempt Organizations Group at Farella, Braun & Martel. If you have suggestions for topics you would like for us to discuss, please email us at eoradioshow@fbm.com. That's eoradioshow@fbm.com. Thank you for joining us. Until next time, make a difference.